Imagine a world where you are your own bank. No managers, no paperwork, no middlemen taking a cut. Just you, a number, and the entire planet as your financial network. This isn't a sci-fi movie. This is cryptocurrency. But let's be honest. If you look at a chart of Bitcoin or Ethereum, it looks less like a currency and more like a roller coaster designed by a mad scientist. One day it's up 20%, the next day it's down 30%. People say it's supply and demand, but that's a cop-out answer. What is the actual machine? What is the mathematical formula that dictates when a new Bitcoin appears? And what invisible forces, part math and part psychology, cause the price to swing? Today we are pulling back the curtain. We are going to break down the technology, the math, and the market mechanics of crypto in the most detailed breakdown possible. By the end of this video, you won't just know what crypto is. You'll understand the gears turning inside the machine. Let's begin. To understand crypto, we have to understand a fundamental flaw in digital money. It's called the double spend problem. If I have a digital file like a Word document and I email it to you, I still have the original copy. That's great for documents but terrible for money. If I could spend a digital dollar and keep a copy of it, I could spend it infinitely. Money would be worthless. For decades, we solved this with a trusted third-party banks. When you Venmo your friend $20, the bank doesn't hand over a physical bill. It goes into its massive digital ledger, finds your account, subtracts $20, finds your friend's account, and adds $20. The bank stamps it and says transaction verified. But what if you don't trust the bank? What if you don't want to pay their fees, or you live in a country where the banking system is unstable? In 2008, a mysterious person or group named Satoshi Nakamoto published a white paper called Bitcoin, a peer-to-peer electronic cash system. His solution was revolutionary. Get rid of the bank and give everyone a copy of the ledger. This is the blockchain. At its core, it is just a database, a giant list of transactions. But here is the genius part. This list isn't stored in one secret vault. It is stored simultaneously on thousands of computers all over the world. These are called nodes. If I try to hack into one computer and change a record to say I paid myself $1 million, the other 9,999 computers would compare notes. They would look at my tampered ledger, see it doesn't match theirs, and reject it immediately. To successfully cheat the system, you would have to control 51% of the computing power on the entire network at the same time. For a coin like Bitcoin, that would cost billions of dollars in hardware and electricity. It is cheaper to just play by the rules. But how do we add information to this ledger? How do we decide who gets to write the next page? This is where the crypto part of cryptocurrency comes in, the math. Let's talk about a specific type of math called cryptographic hashing. Imagine I give you a book like War and Peace. It is over 1,000 pages long. Now I ask you to calculate the fingerprint of that book. That is a hash. A hash function, specifically the one Bitcoin uses called SHA-256, takes any input, a single word, a book, a movie, and spits out a fixed-length string of numbers and letters. It looks something like this, a long string of random characters. Here are the magic properties of a hash. First, it is one way. You can go from the book to the hash easily, but you can never go from the hash back to the book. Second, it has the avalanche effect. If I change just one comma in War and Peace to a period, the resulting hash changes completely. It becomes unrecognizable. In a blockchain, a block is a page in the ledger. It contains three main things. First, the data, which is the list of recent transactions. Second, the previous block's hash. This is the chain link that connects this new block to the old block. Third, the nonce, which is a random number. Now here is the work part. For a block to be accepted by the network, a miner has to find a special nonce. When you combine the transactions plus the previous hash plus the nonce and run it through the SHA-256 hashing machine, the result must start with a certain number of zeros. For Bitcoin, the network might say the hash must start with 19 zeros. Miners are constantly changing the nonce, trying 1, then 2, then 3, generating random hashes. This is a pure guessing game. Miners take the data, add the number 1, and hash it. Does it start with 19 zeros? No. Add 2 and hash. No. Add 3 and hash. No. They do this trillions of times per second. This is the proof of work. It costs massive amounts of electricity because you are burning power to run those guesses. When a miner finally finds the magic number that produces the hash with the right amount of zeros, they broadcast the block to the network. The other nodes check the work instantly because hashing is easy to verify. They agree it is valid and add that block to their copy of the blockchain. As a reward for doing this work and securing the network, the miner gets a payout. This is the block reward, which is newly created Bitcoin, plus the transaction fees from that block. This is the engine. This is the math that keeps the clock ticking. Now we know how new coins are made, but the most interesting part is when and how many. Satoshi coded a strict monetary policy into the Bitcoin software. There will only ever be 21 million Bitcoin in existence, ever. The block reward, which is the amount you get for mining a block, is cut in half every 210,000 blocks. This takes about 4 years and is called the halving. When Bitcoin started in 2009, the reward was 50 Bitcoin per block. In 2012, it dropped to 25. In 2016, it dropped to 12.5. In 2020, it dropped to 6.25. In 2024, it dropped to 3.125. This creates a phenomenon known as stock-to-flow. We can model the total supply using a decay function. The rate of new coins entering the system halves periodically, approaching zero. This mimics the scarcity of precious metals like gold. This mathematical certainty is the bedrock of the price. Unlike a government that can print unlimited dollars causing inflation, the supply of Bitcoin is fixed. So if demand increases, the price must go up. If demand drops, the price goes down. But that brings us to the hardest part. How is that demand calculated in real time? Forget everything you think you know about a stock price. There is no central computer spitting out the correct price of Bitcoin. The price is simply the last trade that occurred between two people. Let's look at the battlefield, which is the order book. On one side, you have the bidders. These are people with limit orders saying, I want to buy 1 Bitcoin, but I refuse to pay more than $30,000. On the other side, you have the askers. These are people saying, I want to sell 1 Bitcoin, but I refuse to take less than $30,001. That gap is called the spread. The price only moves when someone gets impatient. If a buyer gets impatient, they will swipe the ask, meaning they pay the $30,001 to get the coin immediately. If a seller gets impatient, they will hit the bid, meaning they accept the $30,000 to get out immediately. The price action we see on charts is just the history of these impatient decisions. But to truly understand the price, we have to go deeper and look at liquidity. If there is a massive buy wall, for example, a bid for 10,000 Bitcoin at $29,000, that acts as a mathematical support level. The price is unlikely to fall below $29,000 because so many people are waiting to buy at that price. If a large seller dumps their coins and eats through that wall, the price collapses to the next bid down. It becomes a cascade of mathematics. So we have the objective math of the blockchain and the objective mechanics of the order book. But the why behind the buying and selling, that is not math. That is us. There is no mathematical formula that predicts the price, but there is a conceptual framework we can use to understand market cycles. I call it the emotional wave. The first phase is accumulation or the disbelief. The price equals value minus hype. After a crash, the price is low. The smart money or those who understand the technology buys, the public doesn't care. The price moves sideways. The second phase is the uptrend or the dip. The price equals value plus FOMO, which is fear of missing out. The price starts moving up. News articles appear. People who miss the bottom start buying. Every time it dips 10%, they buy the dip. The third phase is the parabolic or the euphoria. The price equals hype multiplied by hype. This is the exponential curve. Your barber is telling you about crypto. Your mom is asking what a wallet is. People are buying because the price is going up, not because they understand the technology. The greater fool theory takes over. People buy because they believe a bigger fool will buy it later for more. The fourth phase is the distribution, or the exit. The early investors look at the parabolic chart. They know this isn't sustainable. They start selling massive amounts to the euphoric buyers. The price stops going up and enters a chop or a top. The fifth phase is the panic or the capitulation. The price equals value minus fear. The price drops 20%. The new buyers panic because they are losing money and they sell. This triggers the price to drop further, which triggers more automated sell orders, causing a cascade. Eventually, the price drops below the true value and the cycle returns to phase 1. Traders use mathematical indicators to try to quantify this emotion. The Relative Strength Index, or RSI, is a formula that measures the speed and change of price movements on a scale of 0 to 100. If it is above 70, the asset is mathematically considered overbought, meaning the euphoria is high and a correction is statistically likely. If it is below 30, it is considered oversold, meaning panic is high and a bounce is likely. Another tool is moving averages. Traders look at the 50-day average versus the 200-day average. If the 50-day crosses above the 200-day, which is called a golden cross, the formula suggests we are entering a bull market. If it crosses below, which is called a death cross, the formula suggests a bear market. But remember, all of these formulas are reacting to information asymmetry. The price of crypto is volatile because the information is new. When a bank collapses, the stock market might dip a little. When a crypto exchange collapses, like the fall of FTX, the price of Bitcoin can drop 20% in a single day because the information changes the perceived security of the entire asset class. We are pricing in the future of global finance in real time. As we look forward, the math is evolving. Bitcoin's proof of work is secure, but it is slow, managing about 7 transactions per second. In comparison, Visa can handle over 24,000 transactions per second. This led to the creation of proof of stake. Instead of burning electricity to guess a number, you stake your coins as collateral. If you validate a fraudulent transaction, the protocol's math automatically takes your money. It is a different kind of security secured by game theory. Then we have Layer 2 solutions like the Lightning Network, which uses complex smart contracts to do transactions off the main chain and settle them later. The math is getting more complex, but the goal is the same: a trustless global digital cash system. So how does crypto work? It works by using cryptographic math, specifically hashing, to create an unbreakable chain of trust. How does the price move? It moves by the simple interaction of buyers and sellers in an order book, fueled by the rigid supply schedule of the halving and the chaotic emotional cycle of human beings, which is fear and greed. Is there one single formula? No. It is a synthesis of 3 things. First, the protocol math, which is the code that creates scarcity. Second, the market math, which is the technical indicators and order book depth. Third, the human math, which is the psychology of the crowd. Understanding crypto isn't about predicting the future. It is about understanding the machine. Once you see the gears, the hash, the nonce, the halving, the bid, and the ask, the chaos starts to look a lot like order. Thank you for watching this deep dive. If you want to understand the next chapter of this technology, hit that subscribe button and ring the bell. I will see you in the next one.